I'm John A.G. This is the Collapse Files, documentary analysis of monetary system failures. We don't predict, we reveal patterns. Let's begin. In 1971, when President Nixon closed the gold window and severed the dollar's link to physical metal, the United States government debt stood at $398 billion, or approximately 34% of GDP. Economists warned that removing gold backing would lead to fiscal irresponsibility and unsustainable debt accumulation. They were dismissed as alarmists. Debt, officials assured, would remain manageable because market discipline would replace gold discipline. Today, in late 2025, the United States government debt exceeds $36.2 trillion, a number that represents over 129% of GDP. But that headline figure, alarming as it is, conceals something far more dangerous. The ratio of total debt, government, corporate, household, and financial sector combined, to the productive capacity of the economy has reached 356%. That number, by any historical or mathematical standard, should not exist in a functioning monetary system. When total debt exceeds productive capacity by more than 3.5 times, and when that ratio continues expanding, while the ability to service the debt through growth deteriorates, what does history reveal about how long the illusion can be sustained before the mathematics force a resolution? For most of recorded history, the concept of debt that could not theoretically be repaid simply did not exist on a systemic scale. Individual borrowers might default, merchants might fail, even kings might repudiate obligations. But the total debt stock of a society remained constrained by the productive capacity to service it and the availability of physical money to represent it. Under commodity money systems, gold, silver, or bimetallic standards, debt was inherently self-limiting. To lend money, one had to possess money to lend. To borrow, one had to convince a lender that future production would generate the means to repay. The physical scarcity of metal money meant that total debt could not expand indefinitely beyond the economy's capacity to produce the goods and services needed to service it. The Roman Empire operated under this constraint for centuries. The aureus, a gold coin containing approximately 8 grams of gold, served as the standard for large transactions and savings. The denarius, initially a silver coin containing about 4.5 grams of silver, served for everyday commerce. Debt existed. Moneylenders were common, interest rates were regulated, and debt crises occurred periodically. But total debt remained bounded by the supply of gold and silver in circulation, and the productive economy's capacity to generate surpluses for repayment. When Roman emperors began debasing the denarius, reducing silver content from 95% to eventually less than 5% over 250 years, the initial effect was to increase the nominal money supply, allowing more debt to be created. But this did not increase real productive capacity. Prices rose. The purchasing power of debased coins fell. Creditors who had lent sound money demanded repayment in sound money, not the debased currency. The mismatch between nominal debt and real capacity to repay created cascading defaults, economic disruption, and ultimately contributed to the empire's fragmentation. The key lesson was that debt denominated in debased currency might appear manageable in nominal terms, but creditors eventually demanded payment in real value. When the gap between nominal debt and real productive capacity became too large, the system broke, not through orderly adjustment, but through defaults, currency rejection, and systemic collapse. Medieval Europe operated under similar constraints, but with additional legal and religious limitations on debt. Usury, charging interest on loans, was prohibited by the Catholic Church as sinful. This theological constraint limited debt accumulation. When monarchs needed to finance wars or palaces, they could borrow from Jewish moneylenders, exempted from Christian usury prohibitions, or from Italian banking houses, but the amounts were limited by lender willingness and capacity. Defaults were common. Edward III of England defaulted on loans from the Bardi and Peruzzi banks in the 1340s, bankrupting them and triggering financial crisis across Europe. The Spanish monarchy defaulted repeatedly: 1557, 1575, 1596, 1607, 1627, 1647, despite controlling the world's richest silver mines. Each default represented a point where debt had exceeded the capacity to service it through taxation or production. The resolution was not extension or refinancing. It was default, creditor loss, and often war. The critical constraint in all these systems was that debt creation required a creditor with existing wealth to lend. This meant total debt could not exceed total wealth by large multiples indefinitely. Someone with 100 gold coins could lend them at interest, creating debt. But they could not create 1,000 gold coins worth of debt from thin air. The physical limitation of commodity money constrained leverage. The Bank of Amsterdam, established in 1609, began to weaken this constraint through the innovation of bank money. Merchants could deposit gold or silver and receive bank credits transferable to others. The bank discovered it could issue more credits than it held in metal reserves because not all depositors demanded redemption simultaneously. This was the genesis of fractional reserve banking, creating money and debt beyond physical backing. For over 150 years, the Bank of Amsterdam maintained conservative practices. Credits issued remained close to metal reserves. When redemptions increased, the bank could deliver. But in the late 18th century, the bank began lending against its reserves more aggressively, creating credits far exceeding metal backing. And when this became known and redemption demands surged, the bank could not deliver and collapsed in 1791. The lesson: debt and money creation beyond physical backing works until confidence fails. Then it fails catastrophically. The 19th century saw the formalization of fractional reserve banking across Europe and America. Banks discovered they could issue banknotes and accept deposits far exceeding their gold and silver reserves. As long as only a small percentage of depositors demanded redemption simultaneously, the system functioned. This allowed debt to expand well beyond the physical money supply. Economic growth accelerated as credit-financed railroads, factories, and infrastructure that would have been impossible under pure commodity money constraints. But periodic crises revealed the inherent fragility. The Panic of 1837, the Panic of 1873, the Panic of 1893, and the Panic of 1907 all followed similar patterns. Credit expansion, speculation, rising asset prices, a trigger event, sudden redemption demands, bank failures, credit contraction, and economic depression. Each crisis demonstrated that debt created through fractional reserve banking exceeded the system's capacity to convert it all to physical money simultaneously. The Federal Reserve, created in 1913, was designed to prevent these panics by serving as lender of last resort, providing liquidity during crises so solvent banks wouldn't fail due to temporary redemption pressures. But this safety net introduced moral hazard. Banks knew they would be rescued, incentivizing greater risk-taking and more aggressive lending. Debt to GDP ratios began rising from levels that had been relatively stable for centuries. The critical threshold was the abandonment of gold convertibility in stages. Domestically in 1933, when Roosevelt made gold ownership illegal, and internationally in 1971, when Nixon closed the gold window. After 1971, the final constraint on debt creation was removed. Money could be created through central bank operations without any physical backing. Debt could expand indefinitely as long as someone was willing to lend. The question was no longer whether debt could physically be serviced through existing money supply. It was whether it could be serviced through promises of future money creation. The transition from commodity-backed money to pure fiat currency between 1971 and the present transformed not just how money was created, but the fundamental relationship between debt, productivity, and economic sustainability. Under the Bretton Woods system, 1944-1971, the dollar was convertible to gold at $35 per ounce for foreign central banks. This created a constraint. Persistent trade deficits drained U.S. gold reserves as foreign central banks exchanged accumulated dollars for gold. By the late 1960s, dollar claims on U.S. gold vastly exceeded the gold available. The system was breaking. Nixon's closure of the gold window in August 1971 was presented as temporary. It became permanent. The effect was to remove the external constraint on U.S. fiscal and monetary policy. Budget deficits no longer risked gold outflows. Money supply could be expanded without limit. Debt could accumulate as long as someone would buy Treasury bonds. And the Federal Reserve could always be that buyer of last resort. The immediate consequence was inflation. Consumer prices rose at rates not seen since the Civil War, exceeding 13% annually by 1980. But inflation was eventually contained through aggressive interest rate increases by Fed Chairman Paul Volcker, who raised rates above 20%, accepting recession to restore price stability. The lesson seemed to be that even pure fiat money could be managed responsibly through central bank discipline. But a second, subtler consequence was the explosion of financialization and debt. With no gold constraint, financial engineering became the dominant source of economic activity in developed economies. Derivatives, securitization, leverage, and complex instruments allowed debt to be sliced, packaged, and multiplied far beyond underlying assets. The financial sector's share of corporate profits rose from approximately 10% in the 1950s to over 40% by the mid-2000s. This was not productive growth. It was extraction and leverage. Total credit market debt, the sum of government, corporate, financial sector, and household debt, stood at approximately $1.6 trillion in 1971, roughly equal to GDP. By 2000, it had reached $27 trillion, or 270% of GDP. By 2008, on the eve of the financial crisis, it exceeded $50 trillion, or 350% of GDP. The ratio of total debt to productive economic output had more than tripled in less than 4 decades. This expansion was enabled by several mutually reinforcing dynamics. First, The Federal Reserve's implicit commitment to prevent financial system failure, the Greenspan put, and later the Bernanke put, meant that excessive leverage would be bailed out rather than allowed to fail. This encouraged more leverage. Second, globalization allowed the U.S. to run persistent trade deficits, importing goods while exporting dollars that were recycled into treasury bonds, financing government debt at low rates. Third, financial innovation created the illusion that risk had been dispersed and managed through derivatives, when in reality it had been concentrated and amplified. The 2008 financial crisis revealed the fragility. The shadow banking system, investment banks, money market funds, hedge funds, had created trillions in debt through repo markets, securitization, and derivatives, much of it backed by subprime mortgages and other dubious assets. When housing prices stopped rising and defaults began, the debt pyramid collapsed. Bear Stearns, Lehman Brothers, AIG, and others faced insolvency. The entire global financial system teetered on the brink of implosion. The response was unprecedented. The Federal Reserve and other central banks provided trillions in emergency lending and asset purchases. Governments bailed out banks deemed too big to fail. Interest rates were cut to zero. Quantitative easing, central bank purchases of government bonds and other assets, expanded Fed balance sheets from under $1 trillion before the crisis to over $4 trillion by 2015. The debt that had caused the crisis was not reduced, it was socialized, transferred from private sector balance sheets to government balance sheets and financed through money creation. This set a precedent. When debt becomes unsustainable, the resolution is not default or restructuring, but bailout and monetization. The consequence was that debt resumed expanding after a brief pause. By 2019, total U.S. credit market debt exceeded $75 trillion, approaching 360% of GDP. The ratio had not only not normalized after the crisis, it had increased. Then came the COVID pandemic in 2020. Governments imposed lockdowns, halting large portions of economic activity. The response was even more extreme than 2008. The Federal Reserve expanded its balance sheet from $4 trillion to $9 trillion in months. The U.S. government enacted over $5 trillion in fiscal stimulus, direct payments to households, expanded unemployment benefits, business loans and grants, and state and local government support. Other nations followed similar patterns. The justification was that the crisis was exogenous, caused by a pandemic, not by underlying economic imbalances. Therefore, extraordinary support was needed to bridge the gap until normalcy returned. But the effect was to validate the principle that any economic disruption, regardless of cause, would be met with unlimited monetary and fiscal response. This eliminated the last vestige of market discipline on debt accumulation. By 2021 or 2022, inflation returned with a vengeance. Not the 2 to 3% central banks targeted, but 8 to 9% in the US and higher in Europe. The cause was clearly the monetary expansion and fiscal deficits of 2020-2021, combined with supply chain disruptions. Central banks responded by raising interest rates from near zero to 5.25% in the US by 2023. This was supposed to restore normalcy, reduce inflation, slow growth modestly, allow a soft landing. But raising rates on a debt stock exceeding 350% of GDP had predictable effects. Interest expense on government debt surged from $345 billion in 2020 to over $880 billion in 2024, approaching $1 trillion annually. Corporate debt that had been issued at near zero rates during 2020-2021 began maturing and needed refinancing at 507%. Zombie companies, profitable only due to ultra-low rates, faced insolvency. Commercial real estate, financed with cheap debt, saw property values collapse as higher cap rates reduced valuations by 30-50%. The fragility became apparent in March 2023 when Silicon Valley Bank and several other regional banks failed due to losses on bond portfolios as rates rose. The government and Federal Reserve intervened again, guaranteeing all deposits regardless of insurance limits, providing emergency lending, and effectively backstopping the entire banking system. The message: no significant financial institution or debt holder would be allowed to fail, regardless of the cause. This creates the current situation. Total U.S. debt exceeds $100 trillion when all sectors are included. Government debt alone exceeds $36 trillion. Corporate debt exceeds $11 trillion. Household debt exceeds $18 trillion. Financial sector debt and liabilities are harder to quantify, but conservatively exceed $30 trillion. The total, relative to GDP, of approximately $28 trillion represents a ratio of 356%, a number that should not exist in any sustainable economic system. The 356% total debt to GDP ratio is not merely a large number. It represents a mathematical impossibility under any scenario involving normal economic growth, inflation, and interest rates. To understand why, consider the mechanics of debt service. If total debt is $100 trillion and the average interest rate is 4%, annual interest expense is $4 trillion. If GDP is $28 trillion, interest expense represents 14% of total economic output. This means that 14% of everything produced in the economy must go to servicing debt before any principal is repaid, any consumption occurs, or any productive investment is made. But the reality is worse because the 4% average interest rate is optimistic. Government debt carries rates of 4 to 5% currently. Corporate investment grade debt averages 5 to 6%. High yield, junk. Corporate debt averages 8 to 10%. Household debt, mortgages, auto loans, credit cards, averages 6 to 8% depending on mix. A weighted average across all debt categories likely exceeds 5%, implying annual interest expense approaching $5 trillion, or nearly 18% of GDP. For perspective, total federal government revenue in 2024 was approximately $4.9 trillion. If interest expense on government debt alone reaches $1.2 trillion in 2026 as projected, that represents 24% of federal revenue consumed by interest before any government services are funded, defense, Social Security, Medicare, or anything else. At 30% of revenue going to interest, a level reached by Italy in the 1990s before requiring IMF intervention, the situation becomes fiscally unsustainable. But government debt is only $36 trillion of the $100 trillion total. Corporate debt service must come from corporate earnings. If corporations collectively owe $11 trillion at average rates of 6%, annual interest is $660 billion. Total corporate pre-tax profits in the U.S. are approximately $3 trillion annually. Interest expense of $660 billion represents 22% of corporate profits consumed before any taxes, dividends, or reinvestment. This is manageable in aggregate, but masks huge variation. Healthy companies pay easily, while heavily leveraged companies struggle or fail. Household debt service is already at concerning levels. Total household debt of $18 trillion for mortgages, auto loans, student loans, credit cards, at average rates of 6% implies annual interest of $1.08 trillion. Total household disposable income is approximately $19 trillion. Debt service of $1.08 trillion represents 5.7% of disposable income, near the high end of historical ranges. During the 2008 crisis, household debt service peaked at 6.2% before deleveraging began. We are approaching that threshold again, but without the housing bubble asset appreciation that supported it then. The compounding problem is that debt continues growing faster than GDP. U.S. government debt is increasing by approximately $2 trillion annually. Fiscal deficits of $1.9 trillion in 2025, plus interest accruing on existing debt. Extrapolating forward, government debt of $36 trillion in 2025 becomes $38 trillion in 2026, $40 trillion in 2027, $42 trillion in 2028. GDP growing at 2.5% annually reaches $28.7 trillion in 2026, $29.4 trillion in 2027, $30.1 trillion in 2028. The government debt to GDP ratio rises from 129% to 132% to 136% to 140%. And this assumes no recession, no financial crisis, and no acceleration of deficit spending, all optimistic assumptions. Total debt follows similar trajectories. If corporate debt grows at 4% annually, household debt at 3%, and financial sector debt at 5%, while GDP grows at 2.5%, the total debt to GDP ratio rises from 356% in 2025 to 365% in 2026, 374% in 2027, and 383% in 2028. The ratio continues deteriorating indefinitely under these assumptions. The only mechanisms that could reverse this trajectory are 1. Nominal GDP growth, accelerating dramatically, requiring either real growth well above historical trends or much higher inflation. 2. Debt growth slowing or reversing, requiring fiscal austerity, corporate deleveraging, and household debt reduction. Or 3. Default or restructuring that reduces nominal debt outstanding. Option 1 seems unlikely. Real GDP growth in mature economies rarely exceeds 3% annually for sustained periods. The U.S. has not achieved 4% real growth since the 1990s. Productivity growth has slowed. Demographics are unfavorable. Aging populations reduce labor force growth and increase dependency ratios. Higher inflation could boost nominal GDP growth, but would also increase interest rates, raising debt service costs and potentially offsetting the benefits. Option 2 is politically and economically difficult. Fiscal austerity, reducing government spending or raising taxes significantly, has proven impossible in the U.S. political system. Any attempt triggers political backlash and economic contraction. The 2013 sequestration, which cut spending modestly, caused sharp slowdowns. Raising taxes to generate $2 trillion annually, the current deficit, would require tax increases of approximately 40% across all categories, politically impossible. Corporate deleveraging would require companies to prioritize debt repayment over investment, dividends, and buybacks. This would reduce stock prices, trigger economic slowdown, and likely precipitate recession. It is unlikely absent a crisis forcing it. Household deleveraging occurred briefly after 2008, but has since reversed as low rates encouraged borrowing. With rates now higher, household debt growth has slowed but not reversed. Option 3, default or restructuring, is the historical resolution when debt becomes mathematically unsustainable, but is politically and economically unacceptable to address through austerity or growth. Sovereigns default, corporations bankrupt, households foreclose, debts are written down, creditors lose, and the system resets. But modern financial systems are so interconnected that allowing significant defaults risks cascading failures. This creates the policy dilemma visible since 2008. Debt is unsustainable, but default is unacceptable. So the resolution is perpetual intervention, bailouts, money printing, interest rate suppression to delay the reckoning. Each intervention adds more debt, worsening the underlying problem while postponing its manifestation. The 356% debt to GDP ratio represents the cumulative result of this strategy. It is a number that should not exist because it cannot be sustained through normal economic processes. It exists only because of the implicit promise that central banks and governments will intervene infinitely to prevent defaults. But that promise is itself unsustainable because it requires infinite money creation, which eventually destroys currency credibility through inflation. The 356% debt to GDP ratio is not just a statistical artifact. It is a signal that markets and currencies are beginning to recognize and respond to in ways that suggest the end stages of the current monetary system. The first signal is the persistent elevation of inflation despite aggressive interest rate increases. Central bank theory suggests that raising rates from 0 to 5.25% should cool demand, reduce inflation, and eventually bring price increases back to the 2% target. But U.S. inflation, after falling from a peak of 9% to approximately 4%, has stalled and shows signs of re-acceleration. Core inflation, excluding volatile food and energy, remains above 3.5%, well above target. The reason is that debt service transfers purchasing power from borrowers to creditors. When rates rise from 0 to 5% on a $100 trillion debt stock, approximately $5 trillion annually flows from borrowers to creditors. Creditors who receive this interest income spend or invest it, creating demand. The demand is not reduced, it is redirected. This mechanism prevents the traditional monetary transmission from working as expected when debt ratios are extremely high. Additionally, governments respond to higher interest costs by increasing deficits rather than cutting spending. When interest on the national debt rises from $345 billion to $1 trillion annually, the government does not cut other spending by $655 billion to maintain fiscal balance. It borrows the additional amount, increasing the deficit, which is financed through new debt issuance that adds to money supply and demand in the economy. Fiscal policy is counteracting monetary policy, preventing the economic slowdown needed to reduce inflation. The second signal appears in currency markets and reserve holdings. The dollar index, which measures the dollar against a basket of major currencies, remains near 20-year highs, suggesting dollar strength. But this strength is occurring while trust in dollar stability is declining, as measured by foreign official dollar reserve holdings. Foreign central banks have reduced dollar reserves from 71% of total reserves in 2000 to 58% in 2024. In absolute terms, foreign central bank dollar holdings peak near $7 trillion and have declined to approximately $6.5 trillion, despite global reserves growing. This means other assets, euros, yen, yuan, gold, are being accumulated while dollars are being reduced. The dollar's nominal strength reflects not confidence, but relative weakness of other currencies, facing similar or worse debt problems. The third signal is visible in government bond markets. U.S. Treasury yields, the interest rate the government must pay to borrow, have remained elevated despite Federal Reserve rate cuts in late 2024 and early 2025. Historically, when the Fed cuts rates, Treasury yields fall in parallel. Currently, 10-year Treasury yields remain above 4.5%, despite the Fed cutting its policy rate from 5.25% to 4.5%. This divergence suggests bond markets are pricing credit risk or inflation risk rather than just following Fed policy. If markets believed the government could service debt without inflation or default, yields would be lower given Fed rate cuts. The fact that yields remain high suggests markets are demanding compensation for risk, either that inflation will erode bond value in real terms, or that debt levels create default risk, or both. The fourth signal is the acceleration of gold accumulation by central banks, despite public statements that gold has no monetary role. Central banks globally have been net buyers of gold for 15 consecutive years through 2025. Annual purchases exceeded 1,000 metric tons in both 2022 and 2023, the highest level since the 1950s. China, Russia, India, Turkey, Poland, Singapore, and others have been aggressive accumulators. This behavior reveals a contradiction. Central banks managing fiat currencies publicly claim gold is a barbarous relic, while privately accumulating it at record pace. The explanation is that central bankers understand the fragility of fiat systems built on unsustainable debt. Gold is insurance against the failure of the dollar-centric system. The accumulation is not preparation for a return to gold standards. It is preparation for the potential collapse of pure fiat arrangements. The fifth signal appears in corporate credit markets. Credit spreads, the difference between corporate bond yields and treasury yields, have widened despite economic conditions that are not recessionary. Investment-grade corporate bonds trade at spreads of 120, 150 basis points over treasuries, up from typical spreads of 80 or 100 basis points. High-yield bonds trade at spreads exceeding 400 basis points, compared to typical spreads of 300, 350 basis points. Wider spreads indicate markets are pricing higher default risk. With corporate debt exceeding $11 trillion and average interest rates near 6%, companies must refinance approximately $3 trillion in maturing debt over the next 3 years at rates potentially double what they originally paid. Companies that were marginally profitable at 2-3% rates become unprofitable at 6%. Default rates have already begun rising from pandemic-era lows and are projected to continue increasing through 2026-2027. The sixth signal is found in commodity markets, particularly precious metals relative to debt levels. The gold price, which should theoretically reflect monetary instability concerns, has risen to over $2,700 per ounce, all-time highs in nominal terms. But adjusted for the growth in debt, gold is actually remarkably cheap. In 1980, when gold peaked at $850 per ounce, total U.S. debt was approximately $5 trillion. Gold's price relative to debt was 0.17 per dollar of debt. Today, with debt at $100 trillion and gold at $2,700, gold's price relative to debt is 0.27 per dollar of debt, 6 times cheaper than the 1980 peak. If gold were to reach the same price-to-debt ratio as 1980, it would trade at approximately $17,000 per ounce. The fact that it trades at $2,700 suggests either gold is severely undervalued relative to debt, or markets do not yet believe the debt is problematic. Historical precedent suggests the former, that gold severely lags the recognition of monetary instability until suddenly repricing violently higher when confidence breaks. All of these signals point toward the same conclusion. Markets are beginning to price the unsustainability of current debt levels, but are doing so gradually and incompletely. The repricing is occurring in stages, first in inflation persistence, then in currency reserve shifts, then in bond yield elevations, then in credit spread widening. The final stage, sharp currency devaluation, bond market collapse, or systemic crisis, has not yet occurred, but the preliminary signals suggesting it will occur are present and intensifying. History provides clear precedent for what occurs when debt to GDP ratios reach levels comparable to the current 356%, and when the mathematical impossibility of sustainable servicing becomes undeniable. The most direct comparison is Japan, which reached a government debt-to-GDP ratio exceeding 250% by 2020, the highest among developed nations. Japan avoided default or crisis through several specific conditions: domestic creditors holding most debt, reducing foreign exchange risk, a large current account surplus, meaning external balance, and near-zero interest rates maintained for over 2 decades, minimizing debt service. But even Japan has struggled. Economic growth has been anemic, averaging under 1% annually for 30 years. Deflation has been persistent. Living standards have stagnated. The yen has depreciated significantly, losing over 30% of its value against the dollar since 2020. The Bank of Japan has been trapped. It cannot raise rates without triggering fiscal crisis, but keeping rates at zero perpetuates economic stagnation and currency weakness. Japan's experience suggests that very high debt can persist longer than theory predicts under specific conditions, but the cost is permanent economic underperformance and gradual currency erosion. The United States does not have Japan's advantages. U.S. debt is substantially foreign-held, the current account is in deficit, and the political system is unlikely to accept decades of stagnation and austerity. The Weimar Republic provides the opposite precedent: how rapidly debt sustainability can collapse when confidence fails. Following World War I, Germany was required to pay war reparations to Allied powers. Unable to raise sufficient taxes due to economic destruction and political instability, the government resorted to printing money. The money supply expanded exponentially. Prices rose exponentially. The mark's exchange rate against the dollar went from 4.2 marks per dollar in 1914 to 4.2 trillion marks per dollar in November 1923. The hyperinflation was not simply a monetary phenomenon. It was the consequence of attempting to resolve unsustainable debt through currency creation. The Reich's debts became unpayable in gold or hard currency. Printing marks to pay debts denominated in marks destroyed the mark's value, requiring more printing in an accelerating spiral. The resolution was currency collapse, economic chaos, political radicalization, and ultimately the rise of fascism. The United States cannot experience Weimar-style hyperinflation in the same form because U.S. debt is denominated in dollars, the same currency the Federal Reserve can create. The U.S. cannot technically default in nominal terms because it can always print dollars to pay obligations, but it can default in real terms through inflation that destroys the purchasing power of both the debt and the currency. This is the path of least resistance for resolving unsustainable debt. Allow or engineer inflation of 5 to 10% annually for a decade, halving the real value of debt while nominally servicing it. Creditors lose in purchasing power terms. Savers lose. Anyone on fixed income loses. But the system avoids the chaos of explicit default. This is implicit default, honoring nominal obligations while destroying their real value. Historical episodes of high inflation used to resolve debt include the U.S. post-Civil War period, when greenback inflation reduced war debt burdens, the UK and France post-World War I, when moderate inflation reduced war debts, and numerous Latin American nations in the 20th century, where periodic high inflation wiped out domestic debt while restructuring foreign debt. The common pattern is that inflation initially appears controllable, 5 to 7% rather than hyperinflation, but once inflation expectations become entrenched, bringing inflation back down requires severe recession or economic contraction that is politically unacceptable. The alternative is accepting higher inflation as the new normal, which gradually erodes currency value and purchasing power. For the United States specifically, the consequences would include declining international reserve currency status as foreign holders reduce dollar exposure to avoid losses, higher import prices as the dollar depreciates, persistent inflation requiring higher nominal interest rates that increase debt service costs, and eventually a feedback loop where inflation raises debt service faster than it reduces real debt burdens. The geopolitical consequence would be profound. The dollar's reserve currency status has allowed the U.S. to impose financial sanctions, control global payment systems, and finance deficits at below market rates. Loss of reserve status would eliminate these advantages. Sanctions would become less effective. Payment systems would fragment. Borrowing costs would rise. The geopolitical influence derived from monetary dominance would diminish. For individuals, the practical consequence is the destruction of savings denominated in currency. A $100,000 retirement account losing half its purchasing power over a decade due to 7% annual inflation is economically equivalent to a 50% default. Workers on fixed wages that don't keep pace with inflation experience declining real incomes. The middle class, which holds most wealth in currency-denominated assets rather than real assets, bears the brunt. The wealth transfer is from creditors to debtors, from savers to borrowers, from fixed income recipients to owners of real assets. Those with foresight who shifted into real estate, commodities, precious metals, or inflation-protected assets preserve wealth. Those who trusted currency-denominated savings and bonds lose. The broader systemic consequence is the breakdown of trust in institutions. When governments resolve debt through inflation rather than honest default or austerity, citizens recognize the implicit theft. Trust in government, central banks, and financial institutions erodes. Political radicalization follows. Citizens support extreme movements promising to restore lost prosperity or punish those blamed for losses. This dynamic preceded the rise of fascism in 1930s Europe and has recurred in various forms during every major monetary system failure. The 356% debt to GDP ratio makes all of these consequences increasingly probable. The mathematics do not allow for normal economic growth and debt service. Something must give. Either growth accelerates dramatically, historically unlikely, debt is reduced through default or austerity, politically unacceptable, or debt is inflated away, path of least resistance but economically destructive. History suggests which option gets chosen, and history suggests what follows when it is chosen. In 1971, when the gold window closed and debt stood at 34% of GDP, economists warned that removing gold discipline would lead to unsustainable debt accumulation. They were dismissed. Debt would be constrained by market discipline, officials assured. The market would not allow debt to reach truly dangerous levels because interest rates would rise, making borrowing expensive and forcing fiscal responsibility. The current reality is 356% debt to GDP. The market did not prevent this. The market enabled it through low rates, quantitative easing, and the implicit promise that central banks and governments would prevent any significant default regardless of debt levels. Each crisis, 2008, 2020, 2023, was met not with deleveraging but with more debt and more intervention. The number 356% should not exist. It represents a mathematical impossibility sustained only through the belief that intervention can continue indefinitely, but intervention requires either perpetual economic growth to outrun debt accumulation or perpetual money creation that eventually destroys currency value through inflation. Historical precedent provides no examples of nations successfully managing debt to GDP ratios above 300% without either default, currency collapse, or prolonged economic stagnation. The signals of unsustainability are present and multiplying. Inflation persists despite rate increases, currency reserves shift away from dollars, bond yields remain elevated despite Fed easing, corporate credit spreads widen, central banks accumulate gold while claiming it is irrelevant. Each signal individually might be explained away. Collectively, they paint a picture of a system approaching mathematical limits. This is not a prediction of when the break occurs. Unsustainable systems can persist far longer than logic suggests. Japan has maintained over 250% government debt to GDP for 2 decades. But persistence is not sustainability. Japan has paid for high debt with 3 decades of stagnation, currency depreciation, and declining relevance. The U.S. path, given different structural conditions, is unlikely to parallel Japan's quiet decline and more likely to parallel more volatile precedents. The consequence of the 356% ratio is not in question. It is mathematically certain. Debt this large, relative to productive capacity, cannot be serviced through normal growth and interest payments. The only question is the form the resolution takes: explicit default, unacceptable to policymakers; austerity and deleveraging, politically impossible; persistent stagnation, the Japan model; or inflation destroying real debt value while nominally servicing it, path of least resistance. If the resolution follows historical patterns from similar episodes, it will be the 4th option: inflation. Not hyperinflation necessarily, but persistent 6 to 10% inflation for a decade or more, having the real burden of debt while destroying the purchasing power of currency and savings. This allows nominal obligations to be honored while real obligations are repudiated. It is implicit default, politically easier than explicit default, but economically destructive nonetheless. The 356% debt to GDP ratio is the number that reveals this outcome is not speculative. It is increasingly inevitable. The mathematics allow no other conclusion. And the signals from markets, currencies, and commodities suggest the recognition of this reality is beginning, even if the full consequences have not yet manifested. This number shouldn't exist, but it does. And its existence changes everything about the sustainability of the current monetary system and the preservation of wealth within it.